Hello everybody, this is Ivan Illan, the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. I'm coming to you today from Hong Kong, working here for a few weeks. And as you may know, we are global macro investors at our firm and investing globally, global equities, also global fixed income, and of course cash. And we're pretty tactical in how we go about allocating across the asset allocation spectrum. And right now, as you may have heard from other videos or certainly from our client review meetings, we are underweight in US large cap equities and continue to remain so. And that's actually favored us quite a bit so far year to date. As an example, the MSCI All Country World Index, excluding the USA, is up about 6.8% year to date, whereas the S&P 500, and this is through this past Friday, is negative about 4.13%. So negative 4%, up 7%. This is essentially an 1,100 basis point, 1,000 basis point differential, quite significant. So we've been waiting a while to see this kind of outperformance occur within the foreign markets, developed foreign markets, emerging markets as well. And so this is quite encouraging and frankly quite expected that we should see this cyclicality come back into the markets, especially given the very, very high valuations that we have seen in the US equity markets. And those valuations, even though they've come back a bit, are still a bit stretched and a bit frothy relative to historical norms. And so the idea that we may see continued underperformance in US equities, specifically US large cap equities, it isn't such a far-fetched thought. So we continue to be positioned accordingly, and our portfolios this year are actually positive year to date by a couple of hundred basis points. Our most aggressive portfolio up a couple of hundred basis points, which we're very happy to see, and frankly by design that's what we would expect given its limited exposure to US large caps, specifically within the technology sector, which has gotten hit the hardest, which is down about 8% this year. So something else that's been quite interesting to note is that spreads, option-adjusted spreads on bonds, which is a really important metric to reference when trying to figure out the level of risk or risk perception that's actually coming into the marketplace, has gone up a little bit, but it really hasn't gone up with broader increase in volatility. And you can actually look at these different types of metrics on volatility, like for example the CBOE volatility index, the VIX, and you can see historically that there is quite a bit of correlation between what happens in, for example, double B US high yield spreads versus the VIX, but we haven't really seen that level of correlation in this recent increase in volatility. So what does that mean? Well, that means something's different. Something is not like it was historically. The demand for fixed income has remained quite high. And usually within high yield, you do see a high correlation between what's happening in equity markets domestically, and then high yield bond markets tend to move in really high correlation to one another. And we haven't seen that happening to much extent this year. So that is, I think, very informative. The fixed income investor, or perhaps even someone who has been a equity investor, is now seeing the rates of return and the yields that are available within fixed income, maybe in the higher yield space, and they're actually quite impressed with those yields and making allocations there while exiting equity markets but actually going into fixed income markets and getting some pretty decent yields, 6-7% type yields in that part of the U.S. corporate market. So this could be something quite interesting to continue to watch. We made a bit of an allocation to that last year, but with a forecast of expecting to see broadening or widening spreads as volatility increases. So we haven't seen that occur yet, but our expectation would be that we may see some widening of spreads come as more risk perception enters into the market. And finally, with the backdrop of employment and tariffs and a lot of this concern that's certainly spooked the markets year to date, something quite notable has happened, and we saw this in unemployment, the unemployment rate, specifically the U6 unemployment rate. And there's a bunch of different unemployment rates, and if you go to our website and look at research highlights, you'll actually see different unemployment rates. The most popular one is the U3 rate. And right now that's around 4.1% unemployment. Well, if you actually include the underemployed into that figure, we're really at a 3-year high on unemployment, looking at and referencing the U6 figure. So this is really important. It means people that are otherwise looking for full-time work are not able to find it and instead accepting part-time work. And so they're really underemployed. This would be a symptom of economic slowdown and somewhat of a recessionary condition. So, and obviously the recessionary condition is starting to pull back on consumption, which we haven't really quite seen yet. But remember, the majority of consumption in the United States that does occurs within the very top band of income. And so that tends to be more persistent and more sticky from a consumption standpoint. But at some point, it does actually get pulled back a little bit. But in the meantime, we're seeing unemployment rates actually increase. And so referencing different types of unemployment rates, I think, is incredibly helpful to get a bigger picture of what's really going on in the U.S. economy, and something I think to continue to take a look at as we go through this market cycle and this business cycle over the next few months. The impacts of tariffs have yet to be seen, but clearly has caused some consternation and quite a bit of worry in the markets, rightfully so, because they are naturally inflationary. And I think Warren Buffett actually said it very, very well, which is tariffs are actually acts of war, which you would think, coming from Warren Buffett, who tends to be, a very, demure and kind of gentle soul, for him to use that kind of language, I think, is very telling, and something certainly I think the market is agreeing with, and to see the retaliation underway right now from economies that have had tariffs put on them means we could be in this period of time of uncertainty and inflationary pressure. And of course, the greatest worry and risk that most economists have is the risk for stagflation, meaning growth could actually be quite tepid or really not do much, but you could actually see the price of things increase. And that would be a very, very difficult thing for the U.S. economy and the U.S. consumer. So from our perspective, we're always thinking global, we're always looking global, and we're very encouraged to see this dislocation or disintermediation between developed economies and emerging economies around the world. This is the way it used to be. 20 years ago, this was very normal, where you would see latency in the U.S. market, but other markets around the world would actually be very virile and really experiencing some nice growth, or at least some stability relative to the U.S. market. And given the trade war type posturing going on right now, it makes sense to be looking back in time and saying, well, maybe 20 years ago, when the U.S. was the major trading partner for most nations around the world, there was a lot of ability to impose these tariffs and get what you wanted out of them. Today, with China really being the dominant trading partner with most developed economies and emerging economies around the world, maybe that requires a second thought of the efficacy of such tariffs. So that has yet to be seen, and obviously a lot of uncertainty is not enjoyed by the US stock market. But meanwhile, a lot of other markets around the world are doing quite well. So let this serve as a reminder to keep your horizons broad and wide. And of course, if you have any questions at all for our clients, please call us or email us. Always happy to dive deeper. And those really wanting a review of what's going on in your portfolio, don't hesitate to reach out to us as well, and we can have that conversation. Thank you very much for joining me, and take care.